Welcome back, everyone. It's Brian Strain here. We're doing our odds online coaching session today. I have a lot to talk about today. We promised in the newsletter yesterday that we'd be talking a little bit about DJT. This is a headline that kind of dives right into the topic I want to talk about. I don't know if any of you got filled on the trade yesterday. Did anyone get filled on the Trump trade yesterday?
I got filled on a different variation of it.
Different variation? Okay.
I just did one that expired today uh,
Okay.
for a much shorter term. I did let's see, what was it? The 50, I sold the 55 put and bought the 50 for $1.05.
Oh, wow.
Yeah,
Cool.
it's looking like it's working out.
That's good. That is good. We were a little nervous about doing something that close, which is why we went clear out to 10.
Yeah. Well,
Um,
after a while, it was pretty clear
it was not going to go, yeah.
it was up. So I didn't do it right away like it did.
Yeah.
That was later.
Yep, that's what so I didn't get filled either. I tried but didn't get filled. But this headline right here is talking, so Trump media is now the most expensive US stock to bet against. And it talks about the borrowing costs over 200 times average for US listed firms. And what this is talking about is something that we have some cool, unique tools to look at. When you try to short a stock, you have to borrow shares from someone. And when you borrow shares, just like any other, when you take a loan for a house or for a car at the bank, you have to put up collateral. Once the inventory of shares that are shorted dries up, the stock becomes very difficult to borrow. And just supply and demand economics, we know that if the demand is high and the supply is short, the cost is going to go up, right? And so clearing firms charge a fee known as the negative rebate rate or a negative borrow rate. Good news is Odds Online is the only option software that provides up-to-date estimates of negative borrow rates for every optionable stock. You can see here on Trump Media yesterday, or this is actually from today, but uh, I'll show you here where it's found in Odds Online. You just go up here to fundamentals. So there's a couple places where we show this. We click on fundamentals and it will show you the implied borrow rate right there. And this is yesterday because I've got this dated back one day with the data that we would have had yesterday. It also shows we've got this indicator down here that you can put on a chart called the implied lending rate. And you can see the lending rate was pretty consistent. The implied lending rate was pretty consistent along here. And then it started to dive into negative territory back here. And then after the acquisition was a lot more certain that it was going to happen, the implied borrow rate just took a really big negative dive. And and so that's another spot where you can look at the implied lending rate here and you can look at its trend over time. Another place where you can see it is right here. Whenever you click on one of these dates, you can look at the implied borrow rate that those options are from that expiration are implying. And you can see it right here. That's something that's going on. So when the stock gets hard to borrow, the 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 lending rate, the cost to borrow those shares starts to get really high. And we actually have a scan. It's a proprietary scan here. And again, we're the only ones that have this. You can do a scan on negative implied borrow rates. And you can get a list of stocks that have all those that have negative implied borrow rates, where the shares might be difficult to borrow. we have this decile 1 up here. So the stocks that have the most difficult to borrow, and you can see Trump Media is right up there. It's at the very top. It's the most difficult to short if you're going to short it. It's a really high borrow rate. And so you know about negative implied borrow rates. Here's what the research shows us. The average 1 month return on stocks that have a negative implied borrow rate is not good. It's not a good bet to bet on those stocks. Usually when the stock becomes hard to borrow, it's because there's so many people shorting it. There's something obvious going on that people expect the stock to go down. And because so many people are expecting the stock to go down when that rate gets negative, it's difficult for the stock to move up. Now, there are instances like GameStop, right, where short squeezes came in, and there's that potential. So if I was actually gaming for a short squeeze, which is not something I typically do because it's not a high probability bet at all. But if I was going to game on that, this is the list I would go to. That's the only way I can see. So we call this the stocks to avoid column. And the reason why is I'm going to show you here in just a second. But the cost of going short the stock or making a short bet that the stock's going to go down is so high that it more than offsets any return you might get in this trade. So we have another scan here that's unique to us. It's called risk-free trades. And I'm going to get into what this is. These are arbitrage plays where you can get a guaranteed annualized rate of return by creating an arbitrage trade using what we call a conversion reversal. It's widely known as a conversion reversal. We're not the only ones that call it that. And you can see, so you have synthetic long positions and synthetic short positions. These are synthetic short positions where you would offset it by buying the stock. And we'll get into the details here in just a second. Then there's synthetic long position where you sell short the stock. And you can see here that even though we get this huge annualized return on a guaranteed rate of return of 211% gain, the borrow rate is so high to sell short the stock that it more than offsets the cost of the guaranteed rate of return that you can get. So you got to be careful with this kind of trade. So let's dive in a little bit closer here on what we're talking about. What is arbitrage? So arbitrage, a lot of times it's buying and selling the same thing at the exact same time. Usually like in different exchanges or in different places or to different people. If you were a market maker and on one exchange you can buy stock for $10 and simultaneously sell it for 11 on another exchange, that's arbitrage, and that's exactly what we're trying to do here. So in order to do that in our accounts, because we don't really have that kind of access as a retail investor, but what we can do is create a synthetic position, an option position that's an equivalent position of a stock trade, right? So here's an example of a conversion reversal. You create an equivalent position to a long stock position by buying a call option and selling a put option at the same strike price with the same expiration. So typically at the money. This creates a synthetic long position. Let's go look at one here on Trump Media. So we're going out to April 19th, and I'm just going to go out here, and this is yesterday's data that we would have had. So you buy the call, you pay the ask price, and you sell a put. Now, usually the time value on the call and the put at the same strike is going to be identical. And that's because if it's not identical, it opens the trade up to these risk-free trades. And there are people out there that just look for rates of return that are slightly higher than the current market and or the current going, guaranteed interest rate. 57.50, sell the put, buy the call. That gives us our synthetic long position. And if the time value was even on both of these, this yellow line would be right here at the break-even point, right? If there was no advantage in doing this, it should be right there at that point, but it's not. Now we go and add selling short the stock to that, and you can see the profit loss graph. It doesn't matter what happens. There's 100% probability of profit in this trade. No matter what happens, we're going to make $5.79, right? So this is a real risk-free trade that was really out there yesterday. And the problem why we're not interested in doing that. Let's go back here. Is because that big profit of $5.79. It doesn't matter what happens here, right? So if the stock goes down to 5, our call becomes worthless. Our put that we sold is going to lose $52.50. We have to buy back the stock at $5. And so our net debit to get out of the trade is $57.50. And we took a credit to open the trade of $63.29. That gives us a difference of $5.79. So that's our profit. And if the stock goes up, it goes up to 100. Our call is worth 42.50. Our put becomes worthless, but we have to buy back the stock to get out of the trade because that's one of the requirements is we have to pay back the stock. That we're going to lose. We're going to pay $100 for 100 shares, and that leaves us a difference of $57.50, and we got a credit of $63.29, so we have a profit of $5.79. So if we go calculate 5.79 divided by the 750, that gives us about a 10% gain between now and April 19th, which is great. And if you annualize that, if you did that it's going to give you a nice big profit of around 200 and something percent. But the problem is that borrow rate you're going to have to pay. And this is, so when Don put this order in his brokerage account, and so this is what we're talking about. Sometimes that negative rebate rate can exceed the return on the conversion reversal. So you got to be careful of that. But here's the message that Don came up when he tried to do that in his brokerage account. The underlying security of this option is currently hard to borrow. If this order results in a short position due to assignment or exercise, a daily borrow fee will be charged. Now this was he was just putting in the credit spread order that we tried to get into. The current borrow rate is 411.25% if all shares of this option were assigned or exercised. The daily fee would be $397.34 based on yesterday's closing price. So if that's the case, then in this case, the chances of that option being exercised, that put option at $10 being exercised, was extremely remote. Extremely remote. And I'm really glad, Dave, that hopefully you haven't been assigned on short put. You probably don't want to be. So if you're in profitable territory, you need to make sure you're watching this before the market closes.
Okay.
Yep.
Yeah.
Because if that results in a short position for you over the weekend, that's a really that's going to offset your gains for sure.
Oh, it expires today.
Yeah. Yeah, so if it expired today and you didn't do anything and it resulted in an assignment, so this is why you just got to do something before the close, because if it's between their strike prices, if you do a credit spread and the stock finishes between your strike prices, the option will be assigned, and then you end up holding the shares over the weekend because the market's not open. Good Friday tomorrow, so it's a holiday tomorrow, so you'd have it for 3 days, and if the daily fee is $397.34, that's going to wipe out.
Yeah.
That's going
Triple
to
the
wipe out
gains.
a lot.
Potential. Yeah, that would. Okay.
Yeah. Yeah.
Oh, that's good.
So
Yeah.
you want to make sure you got it. You want to make sure that that option does not get assigned on you today before the close. And remember also that this is the thing. If that option is assigned, people, even if the market, if the option is not in the money, it won't be automatically assigned. But whoever bought that option from you has the right to exercise. And if they can get a hold of their broker, they could do it usually within half hour after the market close. If they think that the price is going to come down over the weekend, they may exercise and then it goes into a lottery and you might get assigned. So the only way to make completely sure that you are out is to close that trade before the market closes. So if you can, if you know, I don't know exactly where it's at, but you just want to be careful.
Yeah. I'm closing it right now.
Yeah, you just want to be careful. If you can get out and take a profit, that would be awesome.
Yeah. Yep. I closed it at 5 cents.
Awesome.
So I made a buck or
You made
$100.
about, yep,
$100
$100.
on each
Awesome.
one. Yeah, each contract. Yeah.
There you go. That makes me relieved.
Yeah, I'm glad I joined this call.
Yep, that makes me relieved. Yeah, because you just don't want to. This is why we add this to a list of. This is why you got to pay attention to this stuff, and it's on this list of stocks to avoid. Right there, because the consequences. Now I just have to point out too that I know you knew this beforehand because you signed something saying that you understood exercise risk and all that stuff, weekend exercise risk. When you said that you read the characteristics and risks of standardized options, that your broker is, they made you sign something saying that you read it.
Yeah.
Yep. So I know you already knew this because because
Right.
everyone reads that whole thing and understands it in great detail.
Exactly. Just like understand. Right. Yeah. Just like when you download software and you agree to
Yep.
the terms and
Click
conditions.
agree and move on so you can get to the software.
Yeah.
That's exactly right. That's what happens. But that's the standardization of options is what makes a lot of this stuff possible. But we just need to make sure that we understand what it is that we're doing when we do these things, um, and when we make these bets. And in this case, and that's the reason why we went so far, because we could go so far. That's how ridiculously priced these options were. We could go clear down to the 10 strike where there's a, if we go the credit spread that we did, whoop, where did it go? This one right here. Credit spread that we tried to get filled on was sell the 10, buy the 7.5. And we were trying to get a 7-cent credit. So I'm just going to bump this up here. And close that. We're trying to get a 7-cent credit. And that trade has a 99.7% probability of success. So it was ridiculously far out of the money. It's this now, could it happen? It could happen. But we didn't think the likelihood of, especially where they just got this huge pile of cash, it'll take them longer than a month. Now, it could happen, right? The Trump media they've got a long ways to go before they get anywhere close to profitability. Um, and uh, and it's uncertain whether they'll get there or not. But they just got this big pile of cash from the merger acquisition, of the SPAC, and so it'll probably take some. It probably won't go below 10, before April 19th, and that's why we did what we did, because it was just the probability was really high. We could get a decent return, better than what a money market account would make us. It wasn't huge. It wasn't even 10%. What was it, 7 cents on a risk of $1.93, or no, dollar. What would that risk be? $1, 250. So it'd be 243.
Yeah.
243. So if we go grab my calculator again, 0.07 divided by 2.43. So it's going to be a 2.8% return, um, in 3 weeks. 2.8% return in 3 weeks annualized is pretty huge. Um, you might get money market for a year around 2.8 or 3 or something like that. But for 3 weeks to get that much is quite a bit higher than you would get out of a money market account. So that's why we were willing to take the risk. Um, it's just interesting that it's definitely a meme stock. So meme stocks are, you hear all kinds of fun stories, right? Especially if you're, in the Wall Street Bets group on Reddit. um, you'll hear a lot of, different things going on, and in GameStop they were, they were able to cause a short squeeze, doing that kind of stuff. And so I don't know what's going on with Trump media in their. I know that they're definitely talking about a lot of things. So who knows what's going to happen? If a short squeeze happened, that's great for this trade. We're fine with that. What we wouldn't do is buy any of these options, because they are really so expensive that, the cost to buy the options is just too high. It's eating up. The only way to make any money off of this is to sell it, or to buy shares and loan them out to people, right? I know Robinhood has some situations where if you they share the profits with you. Most brokerage firms don't. They'll loan out your shares to other people, and that's one of the ways that they make money on your investments. Besides commissions, they don't make a whole lot. They don't make money on commissions anymore. They have a couple transaction fees and stuff like that, but probably the way they make a lot of their money is by loaning those shares out to others at higher interest rates, um, and some of those brokers might be willing to share that with you if you're willing to take the risk, but the risk is high on assets like this. So it's you know you're betting on how long the company's going to stay solvent when they're being shorted this heavy. You could potentially buy those shares and loan them out and make some money that way. But that's it. So one other thing I wanted to talk about real fast is we do have a Tesla trade that is expiring today. So it's not expiring tomorrow, it's expiring today. Because tomorrow's Good Friday, so we won't have any trade ideas tomorrow morning. It looks like the put on Tesla is where the money is, and so it looks like it's up a little bit. Let's go check the price, and we'll see what's going on. So we got 205. Current price is 176.88. So 76.88, 205 equals this one minus this one, gives us our value, which the stock is, or the exercise value is 28.12. And it looks like we can get out for about 28.15 is the mark price. So it looks like we're going to be able to get out really close to the exercise value. So what I'm going to do is I'm just going to go right here. And since it's expiring today, I'm just going to do it a little bit early to just show you what I do. I'm going to create a closing order to just close that option. I don't care about the other one. It's worthless. So we'll just let that one expire. It's got a limit price of 27.70 right here. So the bid-ask spread is actually kind of wide. But I'm just going to bump it up here to, I'm going to say 28.10 because I'll give him a nickel. And we'll see what the price goes for when I do it. Confirm and send. And it fills right away. And usually if you give them a little bit like that, it actually looks like it sold for a little bit more. It sold for 28.40. So they gave me a better price than exercise value. Can't ask for more than that. So that's one that if you don't do something today, if you have that position and you don't do something today, it would be assigned over the weekend. And on a put, you would be you have the ability to put some stock to somebody else at the strike price. Well, in this case, you're short, right? Because if you put those shares to someone, but you don't have those shares in your account, you're short at 205, and you'd be holding that over the weekend. And short positions have unlimited risk, right, to the upside. So just want to make sure you take profits on those before the market closes today. So, all right, that's all I have. I hope that this was a good session and that you learned something.
Yeah, it was good, really good.
Hey, I'm glad it worked out, Dave. It made it. Oh man, I don't have to sweat now because I know that you're out. Well, thank you guys for coming. I hope you guys have a wonderful holiday weekend. It's Easter in March this year instead of April. Um, so that's it's kind of unusual. It doesn't happen too often, about once every, I think, 7 or 8 years. But it's it's good to it's good to take a little break. And now that you've got some trades off the table, you got some money to spend over the weekend, right?
There you go.
So I hope you guys have a wonderful weekend, and we'll see you back here on Tuesday next week.
You too. Yep.
Have a
Happy
good
Easter.
week. Happy Easter. Bye bye.
Bye.
Which is kind of a promise to pay back the loan, right? And you pay an interest rate. When you short a stock, you borrow shares, you sell those shares, and you have an obligation to pay those shares back. And on top of that, you have an interest rate that you have to pay. So usually those shares come from a broker's inventory. So, somebody else who shares your broker may own the shares, and they borrow from someone else, an account holder there. They borrow from margin accounts of other brokerage firms or clients, or or market makers or whoever owns the shares that are willing to loan them to you for some interest rate.